Hello and Happy New Year. Welcome back. We return in 2026 with a restart to the Credit Compass, your guide to navigating European credit markets. I don't know about you, but I had a nice, relaxing end of the year. The news, however, was far from quiet. Regular listeners will know our ongoing discussion about Europe's growth engine, what it looks like under the bonnet, not just in the headlines. Today is a great test of that framework. Geopolitical tensions, which had been calming, have flared again. And in just the last few days, we've had another leg lower in oil, fresh PMI numbers, new CPI prints from France and Germany, a head-in-the-sand approach to the budget in Paris, and yet another twist in the Mercosur trade saga. We've also seen some preliminary Christmas trading data, but we'll wait for next week's fuller set, though early signs are positive. So, let's start with the data. The Eurozone Composite PMI, the survey where 50 is the line between expansion and contraction, came in at about 51.5 in December. That's down from November, but still in growth territory, rounding off the strongest quarter for the EU since mid-2023. The composite number for Spain remains very strong at 55.6, and Germany is in expansion territory with 51.3. Italy and France are right on the border at 50.3 and 50 respectively. The UK is even in expansion territory as well at 51.4. Services continue to do the heavy lifting across all countries. Manufacturing is still struggling. On prices, the latest full euro area figures we have are for November, with inflation running at 2.1% year on year. Basically, bang on the ECB's target. More interesting are the national prints over the past couple of days. France's December inflation came in at 0.7% year on year, slightly softer than expected. In Germany, inflation in several large states has dropped below 2%, pointing to a national reading around 2.2% for December, down from 2.6% in November. So the short version, activity is okay, not great. Inflation is low and falling in key economies. Now, layer in oil. Brent is sitting around $61 to $62 a barrel, roughly 20% lower than this time last year after its steepest annual drop since 2020. Oversupply is the story. Inventories have built, demand has been softer than feared, and even dramatic geopolitical developments such as the U.S. shift on Venezuela have done little to offset the concerns about a glut. It is worth touching on here the UK as well, where the latest lending and money supply figures point to a gradual thaw in credit conditions. Mortgage approvals have picked up from last quarter's lows, helped by slightly better affordability as fixed-rate products continue to edge down. Consumer credit growth remains firm, though still below pre-pandemic trends, suggesting households are borrowing cautiously rather than exuberantly. Meanwhile, M4 broad money is expanding again after last year's contraction, reflecting stabilizing deposit flows and improving financial conditions. It's not a surge by any means, but it does indicate that the monetary squeeze of 2023 to 2024 is easing, consistent with the Bank of England that's on a slow, steady path towards selective rate cuts. Over the holiday, I wrote a byline for the Business Post in Ireland. The core point that I made was that a stable, slightly boring macro backdrop is exactly what you want if you're trying to unlock investment in infrastructure, defense, and AI. Now, from macro to institutions, we focus now on France. Parliament has passed a 1-month emergency budget extension to keep the government funded into January after lawmakers failed to agree on the full 2026 budget. The law rolls over 2025 spending limits and keeps tax collection and debt issuance moving while negotiations restart. This avoids a U.S.-style shutdown, but it underlines how fragmented the National Assembly is. The medium-term goal is still to bring the deficit, currently above 5% of GDP, back towards the EU's 3% limit. But for now, we only have a temporary patch. And with an election in 2027, the government is keen not to upset too many voters. This brings us to a hot topic in France, but one relevant across the EU, Mercosur. The EU-Mercosur trade deal has been under negotiation for more than 2 decades. It would link the EU with Brazil, Argentina, Paraguay, Uruguay, and potentially Bolivia. Roughly 780 million people and about a quarter of global GDP. In mid-December, EU leaders effectively delayed signing until January 2026, following farmer protests in Brussels and late-stage opposition from France and Italy. Since then, the signals have been mixed. The Commission says it's on the right track and hopes to sign the deal quite soon, but national governments, particularly France, are tightening checks on food imports and pushing mirror clauses to ensure EU standard compliance. The latest indications, though, suggest Italy is now prepared to proceed, reducing those objectors' ability to block the deal this month. If you're a European exporter in machinery, autos, or chemicals, this is a significant opportunity. Deeper access to high-growth South American markets, more diversification away from US-China tensions, and more scale for European corporates. If you're a farmer in France or Poland, it looks like a direct challenge from producers who operate under different environmental and labor rules, hence the tractors in Brussels. Mercosur fits squarely into that third pillar from the byline, trade sitting alongside infrastructure and AI investment. So, let me pull this together. On the data, Europe kicks off 2026 with PMIs pointing to steady, if unspectacular, expansion, inflation roughly at target and below 2% in several economies, oil that's cheap by recent standards, boosting real incomes and easing costs for energy-intensive sectors. On the politics and geopolitics, we have a challenging global environment from Venezuela to tensions around Greenland, and of course, no peace deal in Ukraine. A French budget process limping into 2026 on temporary measures, inconvenient for Brussels, but not yet a crisis. A Mercosur deal that is delayed but not dead, with trade and farm lobbies asserting themselves loudly. Meanwhile, Europe continues to ramp up defense and infrastructure after years of underinvestment, redirect its energy system and invest in AI and data infrastructure, and position itself imperfectly as one of the last major champions of rules-based trade. So what does all that mean for credit markets? Our view hasn't really changed in the last couple of weeks. Central banks are on diverging paths, with the ECB likely to remain on hold, while the Bank of England embarks on a slow easing cycle. Long-term government rates are likely to stay higher for longer. Spreads remain tight and will face pressure from heavy supply this year. But investor appetite for fixed income is strong at current levels and is likely to stay that way into 2026. Stock markets have shown strong enthusiasm for Europe this year as well, as we've seen in the initial days of trading. In other words, the growth engine is there. Deals will get done. The job for investors, policymakers, and for me on this podcast is to keep separating the gauges on the dashboard from the noise in the political debate. That's all for this week's edition of Credit Compass. We'll link the full written byline in the show notes if you'd like to go deeper into those 3 growth pillars. As always, send us your questions, especially on how the French budget or Mercosur developments might affect the sectors you focus on. If you found today's discussion insightful, follow, rate, and share the show. It really helps others discover it. And for deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macrocredit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.